and I will send you the PDF. There are about 70 or 80 pages that you will be able to watch or to read or to reread, and to ask questions if you want after that. And the first classroom was about how to build your whole trading system. We talk about all the components of trading a complete trading system. We talk about how to build an edge, trading expectancy, gain expectancy, the psychological part, the tools of the trader, and the risk management part. And this time I decided to make a focus on how to read stock charts. I put the word in brackets because the patterns are always the same, because they just translate the mass psychology, which is everywhere on the market. So even if you play forex or trades forex or cryptos or futures, you will see the same patterns coming over and over. And because the psychological part never changes, okay? It's why the patterns remain the same. So what I say often is that you have to change, because the market won't change for you. So and the advantage you have is that the market and the mass psychology won't change, okay? So if you change and you become rational in this ever changing and chaotic market, you have chances to put the odds in your favor. Okay, so we're going to start about how I will say often the stock, because I just trade stocks, US stocks, but you can, if you play forex or trade forex, it's the same, the crypto, etc. So I will say stocks, you replace the word by the whatever market you play, and it will be the same. Okay, there are some nuances, but you will make the difference by yourself. Okay. So there is the natural movement of a rising stock. So like you can see on this picture here, you have if you watch a stock rising, it will rise, then make a consolidation phase, and resume his initial trend. Okay, there is no big deal about that. A stock remains the same, rise or a fall. Okay, can be like a simple thing to remind, but you don't have to have so many indicators when the price tells about everything you need to check a movement and to ride it as far as you can. Okay, so the first thing is you have to keep things simple. I see many people using many indicators, and they will always find a period during which their system will have worked, but it's the more you use indicators, the less robust is supposed to be your system. Okay, so you have to understand that there are not many combinations for a stock to rise. Okay, it's the first thing. I am a breakout trader, so I have a little bias about breakouts, but I'm not talking about here. I'm not imposing myself on that subject. It's not because I play breakouts that you can buy the dips, that you can, I don't know, sell premiums if you play options, and whatever you want. Okay, I just show that there are recurring patterns here, and I will here illustrate my my words using charts I made and the system I play but you can extrapolate all that to your own system, okay? And even if you use fundamentals, you can always inspire of this because this is recurring. There are patterns that are found in good books, and that are others that I discovered by myself, but it's not that complicated, okay? What I do every day, it's watching a stock making a first up movement, okay? Waiting, it consolidates, and then breakouts is consolidation, phase or base, and take the pivot point. It's as simple as that. I'm going to show you some examples, and what I mean about this in this classroom is that you really have to focus on what you recognize and do not overcomplicate things. Focus instead on risk management, psychological part, acquiring or building the right mindset. The strategy or the technical part is the easiest part to get. Okay, there are many winning trading systems available for free on the internet. But obviously, many people, it's not enough for people to succeed, because there is the mindset to build the confidence in your system, because when the market will not favor your strategy or system, you will give up. I say in general, people give up as soon as there is the first difficulty. Okay. So you have to backtest your system. You got to find your edge. The simpler is the better, etc., etc. Okay. Pure price action versus indicators. I talk about that. You need the price, only the price. Look at the trend followers in the US that play interest rates, currencies, palladium, wheat, cotton, whatever. They just use only price because on the futures there are open interest. Open interest are less meaning than volumes on the stock market, so they use only a price, and they've made about 30 or 40% per year for decades. Okay, they have large drawdowns, but the drawdown is sometimes the prerequisite for big performance. Okay, risk versus performance. Well, I was talking about breakout trading. I have a word that I found is the first price bar, because before the first price bar, there is no way to trade, and after that, it's too late. So it's like trading the pivot point. So for many years, I knew that I had to take the pivot point, and I was chasing stock, and like traders say, chasing stock is like crime, it doesn't pay. Okay, so there are many opportunities. You'd better miss a bad trade or avoid a bad trade than over trading and taking bad trades after bad trades. Be selective and just play only your edge. Okay. So there are many reliable price volume patterns. Okay, I say reliable. Sorry, I have difficulty to pronounce this word. It's when I say you have an edge, it's not you will never know you will never know the outcome of an individual trade. Okay, you are in a probability world. Okay, so I never know if I'm going to win on this trade because I can't know what the future will like. Okay, will look like. So but I know that I have an edge, and I have to play my edge every time I see my edge, because on the long term, I know that I will be a winner. Okay, so we will talk about the complete handle. You heard about many times, I think, the double bottom, the flat base. Okay, those patterns are for me the most reliable ones regarding pure chances. So we will look at examples of those chart patterns, like trying to explain the history that the price and the volumes tell us, and you know, to exploit those like inefficiencies. In fact, double bottom, you know, the flat base, and there are many others that you will find, but keep things simple. There are many traders that use only one chart patterns for during the life. Okay, so sometimes you see people who trade only the cup with under. Okay, I prefer to use many patterns on, in fact, not many patterns, but all the patterns that give me an edge. Okay, so you can be you can focus your strategy on the cap with under, the double bottom, or the flat base, or whatever. It doesn't matter. Everybody every time people tell you something, you get to challenge it. Everything that I'm going to tell you in during this classroom, you got to challenge it. Maybe I say stupid things. Okay, it's your job to check if I don't say you know, silly things. Okay, I think every trading strategy about every trading strategy system is about going long volatility. Okay, there are people who short volatility, like, you know, selling a put, selling a call, for example, if you trade option. And then many times, and especially the retail trader, even if you make scalping, day trading, position trading, swing trading, you are long volatility. What it means is that you follow a trend. You know, the trend is your friend. You can short, you expect the stock to fall, and you can go long, and you expect the stock to rise. Okay, and very often you're long volatility, because when you're short volatility, in fact, you go in against human nature, and you go against a natural movement, you know, like gravity. Like, but there are people who short volatility, but it's not my business. I think it's maybe a little dangerous, but it's just my thought. Okay, so trend following is a trend system. You know, Michael Cowell talked much about it, like you know, Ed Secota, Tom Basso, etc. They just follow the price and follow the trend, wait to the trend to go against them, and they get out with a big drawdown, but they take a big part of a move. And even if you scalp during a 30 second or 1 minute, you know, the S&P or the Nasdaq a future, to some extent, you are a trend follower. Okay, you can get buy the dips, you can buy the breakout, you follow the trend, and you exit when the price very often goes against you. You can we'll see that later, exit into strength, but sometimes it's not the best idea, because you will miss potentially big moves. We will see that you'd better wait that things go against you to be sure that the movement is over, instead of trying to guess the top of the move. Okay, we cannot achieve that. Okay, so it's a option. It's like an option. You know, you cut your losses short, and you let your profit run. You heard that many times, I suppose. Even if you start trading, it's not a cliche. If you don't manage your risk, if you don't cut your stock, your losses short, you will die really soon. Okay. So I took many of the shots from big shots. Okay. There are some shots I use on another provider, and it doesn't displays the opening price, but whatever, we will watch at candlesticks. Okay. Well, it's a I talk about my strategy, in fact, because I just follow the price, but I use you know, those patterns. I'm going to explain what I do, and after that I will explain to you that I just use many patterns that other traders use, without, like you see on this chart, there are no moving average, there are only price and volume. If you play stocks, I think it's a mistake. I think it's just my thought not to use volumes, because there are good indicators of the powerness of a move. Okay. So here, what I do every time, every day, it doesn't mean that I trade every day, but I try to play very volatile stocks, sometimes penny stocks, stocks like GME, MAC. I play them because they were very, very volatile. I didn't know what they made the industry they were in. I don't look at fundamentals. I don't care about it. I can read fundamentals. I used to do that when I was a prop trader, like, you know, the William O'Neill technique. You use the fundamentals, growth stock with increasing, you know, earnings, etc. But I realized that I missed many monstrous moves by using fundamentals, because when you use fundamentals are lagging indicators. Okay, first, and after that, there are many stocks that are you know, poor fundamentals and that provide huge you know, moves. Okay, it's hard to play stocks whose fundamentals are horrible. Okay, for me, I don't care. Sorry. I just follow the price. There is enough volatility, enough volume. I get into the price, I get into the volume, and I trade only the price. It took me years before getting rid of those fundamental bias, because I was a fundamentalist at first. But I am really happy now to use only those price, because I focus, I think, on objective data that you can't. Everybody who watch this chart here will see the same thing as I do. The interpretation or the translation you will make of this will be different to some extent, but you will see objectively the same things. I will look at fundamentals, for many people, this is too high, this is too low, etc., etc. Okay, but it's my thought. You can use fundamentals. I don't say it's not good. It was not good for me. Okay, I found my style. But here I look at you know, the patterns. In the spike in volatility, I look at you know, increasing power of the stock. I don't know. Here, the first move, I didn't take it because it was too early. I didn't see a pattern. So, but I watched it and I saw that it went from 50 cents to 1.5. So it tripled in about 5 or 6 days. It means that for me, if this stock, you know, make a consolidation base and don't fall after this rise, could follow the same you know, move in you know, in proportion. Like sometimes, I will say, to me, challenge what I say, but to me, the recent past volatility is a really good and reliable sorry, indicator of the future volatility. Okay, for example, if I see a bar price of 30%, 20%, or 10%, 90% of the time, the next bars, when it will resume as a trend, will be about the same, a bit about 20, about 30. Okay, I just only take breakouts after a rise more than 15%. You know, at the closing time, on the closing price. Okay, so it's what happened here. So it made a consolidation, and it's like a capital. We're going to watch, maybe to zoom on this. It tries and it falls a little, and with you know, volume that decrease when the price you know, fall a little like this, and after that it resumes its strength. But many people who bought here now you know, want to break even, so they sell before the previous high, and weekends, we call them weekends, because they have no patience. They just want to break even, and they are, you know, wiped out, and they allow to those who believe in the stock to buy aggressively and the breakout here happens with the big volume since the beginning of the base, and you see the stock rising in the same maybe more, but in the same proportion as the first movement. Okay, and the move, it's just here a bias. I am a swing trader, and my average holding period is about 8 to 9 days. Okay, if you check William O'Neill's was on a weekly time frame, and he talked about 8 weeks. I never understood when he talked about 8 weeks. Why 8 weeks? Because people, companies publish their accounts, every 3 months, and 8 weeks about 2 months. I think he noticed what I noticed after him is that a move lasts between 8 to 12 bars. You can check by yourself. You can go back to the beginning of the 20th century. This is always the same, momentum with the same average holding. I will say average holding or timing. Okay, time the stock takes to make its whole move. Okay, so I check how many bar price I'm in, and here you see that there was a strong exit signals because there was a strong reversal, and there are many people here, entering, and they are all fun weekends, and those were in here on profit from the huge volume and the huge movement to exit. Okay, you understand? And here you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bars. Okay, and we will see that I saw that again and again. It's my style. Okay, but here we talk about the cup with handle. You can have many other patterns, but what you can see that a stock to go from $1 to $5, he has to rise through all the intermediary level. Okay, like 5, 2, 3, 4, 5, etc. Okay, and there was the consolidation phase because there was hesitation. People went out, other people went in, and the bulls won the battle. Okay, I don't say I win every time. I win about only 30% of the time. But when you take a trade like this with only a 10% position size, you have about 1.5. It's a 200% move contribution to your performance. So it means that if you put about 10%, it's what I do, you have a contribution on one single trade with only 10% of 20% on your whole performance. Okay, and it can cover about 20 losses if you bet only 1% of your capital. And I suggest you do that because it will probably avoid to you the risk of ruin, like we say. Okay, here another example of trade. It's always the same thing, but here it's again the cap with under. But what I mean, I don't really like technical analysis. I like to be I like to see a story told by the price, like because if you are too demanding on the quality of your setups, you will miss many trades. Because when you say the cap with handle, it's not a science. You have to be selective. Like taking the first bar price, you have to you got to take your strong patterns. You got not to chase stocks. You got not to overtrade, etc. But in fact, if you look at this pattern, it's not perfect. But it was enough because what did tell what was the story of the stock? Okay, here there is a first spike here of a big huge movement. It's about a 20-30% bar price. Okay, so with huge volume, 10 millions. Okay, and a long phase of consolidation and big spikes. But here there is no way to, maybe I don't know, I don't remember. Maybe I entered here and I were stopped out, you know, break even because I just adjust my stop, but it could have been a, you know, a flat base. Here we don't see that things really good, but it fell, okay, and resumed its trend, and people here who bought here were eager to break even. They exited just to feel the good feeling to not to take a big loss. So they exit. They are the weak end because they just follow the average trader's mind. That is, you know, without strategy, without stop loss, without risk management, whatever you can say about you know, the beginning traders. Okay, we call them weak ends. And here we have like you know, volatility compression, because this movement, decreasing movement, is lesser than this one. And if you watch the bar price, they are, you know, tighter than here. What it means is that people, and look at the volume when the stock started to resume its trend, which about just after that. In fact, you had a spike here in volatility, a volume, you know, accompanying the stock rise, and here the stock falls, but quietly, and less in, you know, there is less energy downside pressure than the preceding movement. Okay, and here I took it here, I think, on this bar here, because the pivot point here was about 2.5, because this is the highest level of the, like, the handle. Okay, and you see the volumes are not big, but enough to say that people want to get into the stocks at the right moment, and it didn't you know, skyrocketed right from the start, because it made a little consolidation here, like many, I don't know, hesitation. I had no reason to exit, so I remember that I stay on the stock, and just the stock went about, I don't remember, 2.5, 200%. Okay, you have stock like this. Many people avoid those stocks because I suppose they look at the you know, the fundamentals, and they are not really happy to watch those, and they avoid those stocks. I don't care, like I told you, but when you take a move like this, it can cover about 20 to 30 losses in a row. Sometimes it means you can be a loser for me about for 2 months and be still be in the green. So I like those kind of stocks, and this trade is really, for me, obvious. It's what I say on Twitter. I like, and you should, I think, look at obvious trade. People say the most obvious trades are those who fail the most. I don't agree. It's not true. No, because for the beginner, taking a breakout or buying the highest high, like I do many times, is hard at the beginning. But after that, you just play things like you see them. And I don't think I play hard trades. The hardest part is just to trade only obvious trade, because people are prone to take to be the jack of all trades, and over trading is like piranha bites. It will kill you slowly but surely. Okay, so I don't agree that trading has to be hard. No, trading is hard, but it doesn't have to be hard. You just have to be selective. Okay, here again, here we focus, we see more you know, more closely, because but it's the kind of a same pattern if you look at this. Again and again, you see here, I don't know, the mass psychology, you know, starting to have interest in the stock. Okay, you know, you have rising bars, you have white bars with increasing volume. It's just, I'm not doing an odd interpretation. It's reality. The stock rise with rising volume. You can't contest that. You can't say, no, it's not true. It's true, okay? If I use RSI, I don't know, stochastic, or I don't know, Bollinger, or I don't know to say it in English, Bollinger, I think you have many interpretations. I think, but if you look only at price, to me, it's just the mirror of maybe the reality you have just in front of you. And again, it starts first movement, and the stock falls, but decreases, but you know, in an orderly manner. Okay, you have to check the. We're going to look at faulty basis, you know, in sometimes. Very often, the best setups, the strongest stocks comes from consolidation phase that looks harmonic, yes, harmonic, like aesthetic, you know, because the bar price are the mass psychology is like a person, you know, a person, somebody who is quite, who is serious. You can see it, you know, right from the start. Somebody impatient, aggressive, etc., who does everything and wrong. You will see it right from the start. And here you have a big guy whose name is market, and who is, to some extent, the sum of all its components. Me, you, hedge funds, pension plans, governments, etc., etc. Okay, and here, just after this slight decrease, the stock resumes or starts resuming their initial trend here. Okay, but fails to do so because once again it's the capital. People who bought here, and many of them did, at the end of the first little move, suffered from a loss here. And like they do the put stop losses, they wait until sometimes it's too horrible to bear and get out. But here they waited till just before the top. It's why you see, you know, Handel that you know, take a breath just before the highest of the year, the highest of the cap, because they want to break even. Okay, they don't want to wait that the stock to because they doubt it will raise until the recent top. So they sell before the top, which you can see here. And people, or hedge fund, or whoever you want, start, those who believe, those who are insider, start accumulating, okay? Start buying 1 day, 2 day, 3 day, and do it, you know, in an orderly manner. And like you see, the last time we saw about a compression of volatility compression. I think it's Mark Minervini who talked about that first. But you can see that here it's little chaotic, and here the bar price are tighter and tighter, and it's like a flat base into the cap with handle. And you see this movement is more chaotic, decreases more than this one. This is like a je sais plus comment dire ressort, Florent. Comment dire ressort, tu sais? Non, bon, peu importe. And here you have tight bars, okay? Here, I like to watch before, just after I just buy on the closing price. Okay, sorry, there is maybe a question. Are you okay, Florian? One question: you never use moving averages? I used to, but I'm like you know, I have a philosophy behind my training. You know, I want to make things simple, and I used to use moving averages but I saw so many stocks going through the roof. You know, the 50 moving average, the 200 moving average, that it was not healthy for me, because I missed many moves because it was an impediment to the sky. My limit is the sky. A moving average puts a roof or a ceiling. I don't like to have a roof or a ceiling. Just in my house, yes, I like to have a roof, but you know, I like to have the choice. I prefer to wait that things are really clear. I accept you know, volatility, because I know that if I want to take a big move, I have to accept that things going to have, like the trend following system, I have to go against me to tell me that the trend is over. Because the real problem in the trend following is that a trend exists after I don't know what to say it, having finished this move, and the move is finished when it went against you. You understand? It's why you know, the trend follower, they use volatility stops. They say you have you know, a volatility, which is the noise, and if the stock you know fall too much, they get out, because it's not more the noise, it's the end of the trend. Okay, so I don't use a moving average, but I don't say it's not good. It's no good. It's just because I just want to look and be an expert at looking at price, and I only need that. Okay. Je sais plus comment dire écart-type. Attends, j'oublie tout là. Bon, c'est pas grave. So, and here it was a, you know, those threads are like dreams threads, okay, because they are pushed by dreams. They have no fundamentals. They have, you know, it's short, big moves. But people say penny stocks are dangerous for gamblers. Those people never watch the whole things. You know, it's dangerous if you stay too long, if you don't have an exit strategy. But if you watch things like they should be, okay, I the same chart with the moving average. Okay, thank you. Yes, why not? I don't see the, yeah, I don't see the problem with the moving average. Like people always often use always the same moving average, but the best way to use moving average, to me, is to, yes, they can, yes, you can use a moving average. They can be useful. I just say that I don't use them, but it's not because I don't use them. I'm not God. That it's not worth using them. But I know concerning moving averages, people often use only the 10 days, the 50 days, etc. No, the best way to use a moving average is to look at the moving average to which this specific stock obey. Some stocks obey to the 10 day of moving average. Some stocks to the 20s, 30, 50. Okay, you understand? I think it's a nonsense to use always the same moving average, like the 51. If you have a different volatility in your stocks, okay, different level of volatility. It's the reason why if you use the volatility stocks on a arch movement, a rising stocks that fades just afterwards, the stocks are moving average are useless, because if you follow moving average and like exiting when the stocks close under the specific moving average, I'm dead. Okay, it's coherent for me not to use moving average. But if you have a like William O'Neill or people, you know, buying a Tesla or Zoom or whatever, you can use weekly charts and the 10 week moving average. It can have sense, but the more the stock is volatile, the harder to me is to use a moving average. Okay, because moving average is an indicator. a lagging indicator. Even if you take exponential average, it's a lagging indicator. Okay, okay, you understood. Great. So here, there was a simple trade for me, but because here it was an harmonic patterns, so I took here. Okay, I have a stop about 10-15%. I play volatile stocks, so I use not too many too ample stops, but there are, I adjust them after having backtested so many stocks, same patterns. I realized that the stops, I really don't care. In fact, you know, I lose so many times, 70% of the time, that even if I'm stopped out, I will you know, take the trade again. I suppose 12%, 10%, 8% my stop. Okay, sometimes 20% we're going to see on a huge stocks with a big volatility. Okay, and here it was a trade, you know, like you at the opening. I think I exited on the opening price here. Okay, it's 100%. Here you have a beautiful cap with handle. When again, it's like a little. I like people say, like I hear people say breakout doesn't work, day trading doesn't work, scalping doesn't work, penny stocks are for gamblers, etc. Yes, okay. Yeah, I heard everything, but there are always someone who is an expert and at a strategy that the other guy will say it's bullshit. Okay, so you know, focus on what you can do. If your equity curve rise, you have no problem. Okay, you don't care about other people can say. And here it's like bottom fishing because there was no upside move before, but there were spikes of volatility here. Like I say, spikes of volatility is because the stocks, you know, rise, but with a strong reversal at the closing price and with huge volume. When I say huge, not in absolute terms, but relative terms, you know, you see the if you look, you know, this chart, you see that the biggest bars, volume bars here, are you know, right, how do go with rising bar price. Okay, you understand? Here, boom, boom, boom. Even if it's reversal, you see that some, I would say, some hedge fund or some big institutionals start to accumulate or to have the desire to get in the train. Okay, so but the volume decreases with price, but like say it's not you know, it's not the panic. Okay, it starts increasing here, but like you see, the volume follow the rising move of the price. And here you start seeing, like I talk about a cap with handle is in fact a volatility compression pattern. We could say the CV pattern, you know, or VC pattern, volatility compression pattern. Cap with handle is good also, but it's essentially a pattern where the volatility, you know, start subsiding and before there is a big move. Okay, and here there is a little consolidation phase of about 5 bars. I noticed even on weekly chart, and it's what O'Neill says also, you know, below 5 bars, weekly bars, 5 minutes bars, daily bars, sometimes or really often it's not enough time. There was not enough time for you know, traders to accumulate the stock, and it's less reliable. Sorry, this word I'm going to train because I really have a hard time to say to pronounce it. Reliable. You have to below 5 bars. It means nothing. It's noise to me. So I tried so many times and it was not a success. So I gave up. So I like at minimum of 5 bars. Here it's a minimum. and you see that it's like I don't say it's beautiful, but you know, there is something and logical, harmonious, you know. And here the pivot point is about 3.1. You could ask me, oh, what do? You bought at 3.1? No, I don't buy at 3.1. I wait for the closing price because I am on hyper volatile stocks. Like William O'Neill said, you have to buy just after the pivot point. He's right. He's right. You should do that. But I can't. I don't have the pleasure to buy exactly. Even if I see the stocks, you know, breaking out its pivot point, I will wait till the closing bell because there are so many breakouts which fail during the day that and the overtrading was a real problem for me. So I just wait. I have an objective a price at the end of the day. This confirms the initial trend. You have less opportunity at the end of the day. You have more time to choose. You don't have to be you know, glued at your computer screen. So there are many advantages objectively, and for me especially because I was really impatient. I was swing trader. I put about up to 80 trades in a day. I was not a day trader. I was supposed to be a swing trader. I put about up to 80 trades. So and I was losing money. I was you know, my equity curve went skyrocketing like this, but I was a yo-yo trader. So why? I took really good trades. I was taking really good trades who was commanded by my hedge, but I was taking so many bad trades because there were so many fading breakouts that at the end of the day, I was leaking at my horns, you know, and I was screaming. So I stopped, and it feels better. Everything that I learned that the mistake before. I never had just a feeling for something. I just have to learn that I don't have to do that again. You know, it's not like, oh yes, I'm going to play breakout. I'm going to take the closing price because it works on my backtesting. No, I did everything wrong because I had to understand the hardware, like maybe the average guy. That I have to see that it's not working, to feel how it hurts to lose about 20% of your capital in one day, etc., until you learn the lesson. But like I say on Twitter, I'm really slow. I was very slow. I'm probably really slow again, still. But everybody's, you know, it depends on everybody. But beware of your stop. Beware of your risk management. Beware of overtrading. Beware of not backtesting your system, etc., etc. There are always common features to all winning traders. It's all what I say during my mentorships. I said that. After that, I don't talk about my strategy because you don't use mine or you won't use mine. I just talk about my strategy to illustrate what is common to all winning traders. Okay, people who sales, you know, I'm going buy this. This is a nonsense. This is a nonsense. It's not enough. Okay. And this stock, you know, before, after, just after the big point, a good, easy trade. Why? Again, you see that at the end of the move, everything is relative. You could say, hey, Florian, I saw this trade, you know, it remained static during 5 or 10 days, and it went up to 30. But I will answer, but I don't care. I just play about, I have a holding period of about 10 days, 8 days. And this is typically what I'm looking for. You could ask me, why 8 days? I don't care. I don't care why 8 days, because maybe because in a week there are 7 days, almost 8. I don't care. I don't care why 8. I just noticed that. And it works. And here you see at the end of the average holding period, you see that there is a big reversal where the weekends enter, you know, like a crowd, you know, irrational crowd, which thinks probably that the stock is going to go to $100. And after that, I remember that it went down sharply. But here it's a 200% move in 7 days. Question? No. In fact, no. It's a good question. So if it doesn't take off in 11 days, you close your position. No. What I know is that it's like, you know, in an airplane, you have a red, green lights, pressure, speed, etc. And you know that something is wrong, or you enter in the orange zone, and after that the red zone. Okay. If I am on trade at the 11 days, but nothing special happened, I can, you know, take a longest move. When I say 8 days, it's an average. Sometimes I just stay 1 day, and sometimes I stay 20 days. Okay, it's just an average, but on average it's 8. But what I mean, I think the advantage of this strategy is that, like it's hyper volatile stocks, they have some kind of personality. The stocks, when they breakouts, they do that with a huge big volumes. Okay, and when this is the end of the move, they say, hey guy, there is big volumes out there, you know. Here a big reversal, it was a clear signal of exit here. But it depends. But I know that if these spikes, you know, to answer to your question, if these spikes had happened here, I would have probably exited. Why? Because, you know, the risk reward ratio, you know that you have to think in terms of probabilities. I prefer to I assess every time my risk reward ratio, and you have a risk reward ratio in your strategy, but every day your risk reward on a single trade moves. Okay, the more you win, the less chances you have that the stock will maintain its trend. You understand? So if my stock, on average, I love to get about 100 or 200% move. Okay, if the stock rises 50% and makes spikes like this the second or third days, I will stay, because it's not logical. I prefer to stay even if I'm stopped out at break-even point, because I know it's not logical. But if I look at my backtest and at the precedents, you understand what I mean? It's why everything is linked. It's the domino effect. You have to think in terms of risk reward. I have a low hit ratio. My hit ratio is between 20 and 30%. So I have to really take care of my winners. But sometimes people say, but you're crazy. You could have exited when you was 50% up. But I said, no, but not because it's a pleasure to remain, but because I have no reason to exit. You understand? And I know my strategy by heart, because I like it. I build it like you should. You can't copy someone. You can have inspiration. William O'Neill was like a mentor for me, but I just use what he worked, identifying all those patterns. But after that, I make the things by myself. You understand what I mean? So it works. It works. But when I say it works, you get to be demanding. This one, and we will stop with the cap with under. Again and again, you see, I don't know. Wait, comment on fait pour savoir combien on est attends. Tu sais, Florent?
Mais on est de participants.
Ouais, comment on fait pour avoir, parce que j'ai un...
Bah, tu vois pas la liste des gens là?
Non, on est, je ne vois pas au global. Oh, je suis vraiment une tanche.
2, 3, 4, 5, 6, 7. On est 7, 8 avec toi.
Ok, nickel. Bon, ok. Well, again, rise, fall less, and big volume at the pivot point. Pivot point here again, people sold big. It's always the human psychology. They sold at just before the high, you know. Here 0.42 and the high is 0.45. Okay, I didn't invent anything. And here beautiful trade again, because here again, ideally you have to for me, like, because I'm going to tell you how you can build your strategy, because it has to be logical. People can't follow their strategy because they don't understand it. This is the first reason. I don't talk about black boxes. You know, people sell you a system, you plug it on your computer, and after that, everything is okay. No, yes, I saw. No, it's early entry point. You know, I tried so many times the so-called early entry point. Don't be a. I'm not original. You know, I really take. So the question is, do you use some early points or always the traditional pivots? I will say the traditional pivots. Sometimes I really it's really rare, but I feel so much that but I don't care about 2 or 3%, you know. So why wait? I don't have an advantage not to wait. When you want to take a move of 5% or 6%, sometimes you have the temptation to not to follow your rules. You understand? But when you take huge, massive moves, you're not at 2 or 3%. Okay, you're not. It depends on your strategy, but I think you have. If you take a traditional pivot point, if you identify your patterns, you have only one pivot point. And for me, who trades like explosive moves, I just have only one pivot point. Too late after that. When you play weekly patterns, you can enter this week and in 2 weeks, etc. It's okay. It's but what I like in swing trading is like in 1 month you can rotate your trading account about 3 times. So interest compound at a pace or at a speed really fast. You know, making 100% in 1 year with one trade is good. But when you make 100% in 5 days, you can compound exponentially, you know. So I like. I saw, Einstein was talking about the seventh or the eighth marvel of the world, the compounding of interest. It's no lie. On n'est plus que 2 là. Non, putain, j'y arrive pas là. Ok.
Il y a encore plus de monde, hein, on est une dizaine là.
Ok, merci, excuse-moi, je suis vraiment à la ramasse. Ok, sorry, you, okay? Good question, but you know, when people say 90% is psychology, 90% is really psychology. I decided to make this technical session classroom, but it's my least. It's not the one I like, because techniques. I want to be transparent with the community. I want to teach as much as I can of what I learn, but I learn what you have to do to have the right mindset, because my strategy is my strategy. There is nothing original. When people talk about their strategy, I really don't care the strategy. I say, did you make progress? Did you measure your hit ratio, your risk reward, your average position size? And when a trader can't tell me those numbers, I say, you can't have an edge. You can't, because you are in a numbers world, a numbers game, and so you can assess where you are with numbers and where you will be with numbers, and you can measure your progress every day. I'm not really good at math. You don't have to be a PhD at math, okay? Like I said, you have to have a PhD in discipline, okay? So here again, it's about 2 or 30%. I just show you only winning trades because I show you reliable patterns, but don't remember that I lose 70 to 75% of the time. Okay. The double bottom, you know it by heart. This was a really, really good trade here. Easy trade, obvious trade, because, you know, like I say, trading consists in losing the less between two big winners. It seems simple to understand, but if you have, it's when I was starting to be consistent, but I was, before being consistent, I was a yo-yo guy, the yo-yo guy. Okay, I could catch all those trades you saw, but between two big winners, I had so many bad trades that I was losing money, or you know, my results skyrocketed and went down as fast as it went up. Okay, or faster. So when you wait for the closing day, you're not obliged. Maybe you play forex or you're day trader or whatever. Okay, it's not the problem for you. You have to be in the trading session, but you can extrapolate. Say, be demanding. Or I would say it's not. I use the closing price. In fact, it's not the closing price. It's the closing day, because I'm a swing trader and my time frame is daily. So you have to wait when a candle ended is move. You know, if you play 5 minutes candles, you have to wait the candles to end his 5 minute period. You understand? You will do that. So in day trading, you will do that, and I think in swing trading you should do that, because you can be wiped out by so many false breakouts. Okay. The interest in breakout trading that you won't miss a big trend. In fact, if you try to buy the dips to feel cool, you know, the regret bias, bias. You want, it feels good to buy the dips because you were taught that you have to buy these things $10 below, and when someone sells you the same thing at 12. Okay, in trading it doesn't work like this. In trading there is no reference price. Okay, there is no absolute price. I don't care when the bar price is 100%. If it's the pivot point. Okay, you got to think in terms of relative price. In our real life, we measure absolute price and relative price. Okay, if I propose you a telephone at $100 and exactly the same telephone the day 5 minutes after at 80, the same telephone, you will buy it at 80. In the markets, it does work like this. You can buy it at 120, etc. And what the problem is that people, it's what I wrote on Twitter, when they were stopped out at 10. Suppose you buy at 10, okay? You have a stop at 9, okay? You were stopped out at 9, and the stock went down until 8.90. So you were just stopped out, and the stock resumed its trends. I'm sure you experienced this situation. And just after that, it goes to 12, or the day after to 12. 90% of the time, people won't buy at 12 because they say to themselves, I could be on this trade again about it at 10. I can't buy it at 12, but it's a mistake. And you see the stocks going to the sky without you, because you were so proud and you didn't understand that we don't care, and the market doesn't care about the level the stock reached just 2 minutes or I don't know ago. You understand? And you got to be really rational. You know, the rational man. In behavioral finance, we speak about the RIM. Rational economic man. he searches for satisfies. Okay, it's not completely rational. In trading, if you want to win, and I will host a classroom dedicated to specifically to all the psychological bias we all suffer from in trading as humans. Okay, so here spikes of volatility, big bars, 20%. I like this with spikes of volume, always the same, always the same. What is interesting, what I'm saying, I think it's not my strategy again. It's that I always do the same. With I have I wrote something to I have a discussion on Twitter with someone who was, I don't know what we were talking about, but I say the market it's always the same thing. Always the same thing, but differently. And so he said, what the hell are you telling to me? It's always different, or it's always the same? In fact, I say, it's always different and always the same. Why? This one, it's not, you can't enter this configuration. Maybe you can code that. But if you code that, the power of the brains, human brains, like it can recognize the story of the stock, okay, like a double bottom. But last time I showed this shot to someone at the latest classroom. He said, "What do you see a double bottom?" And it was a good question, because in fact we don't care if it's a double bottom. We got to name things because it helps us. But if we couldn't name them, it won't be a problem, because if you follow the story of the price, you will be a winner on the long term with a good mindset and a good risk management. You understand what I mean? Because you won't have a double bottom. It's like being a Picasso, or I don't know, or a big artist, a big singer. They sing maybe the same type of songs, but they are not the same. Okay, it will be boring. It's like the same in trading. We just look at perfection, like there is a there is here a double bottom, here the pivot point is exactly at 8.8. I don't think like this. You have to look at patterns, but be demanding, but do not search for the Graal, because you're going to skip or to miss everything. So the story here was that there was spike of price and volatility, and here again it's the volume decreased and the price decreased. There is a little upside move, and you watch here for the first time in the move here. I would say that these two bars, they are really tight. This is often a sign of accumulation. Okay, and here the move or the strength, the bull strength is not enough, and the stocks falls abruptly and under the preceding relative low here. The double bottom is good when there is this kind of patterns. Here you have a first low and the second low. Here the weak ends will put the stop here are stopped out. Okay, and when they are stopped out, there are many people. In fact, even if you don't see it in the volume of this specific stocks, but there are many people who act the same, like the mob or the mass psychology, the mass, and the weak end disappear. So the bull move. There is no downside pressure. That's what I mean. Downside because they were selling their stocks at this level, and now they are out, so they can't sell their stock again. So it's good for the bull to go again, and the stock starts to rise here. You see the four last bars here. They are really in the same range. You could say, okay, nothing special. Yes, but look, it's really chaotic here. It's still chaotic here, and here it starts really to be, compression of volatility here. You can see that if you get to with your eyes, you make a global move from the left to the right, and you will see that it's like natural move, okay? And here an obvious trend, like it was bar of 37%, I think, and nothing else. But here you can notice something. What you could notice here, look at the green bars, the white bars. I would say the green bars, the rising bars. Look at this one, the spikes with reversal. When I say spikes, the stocks rise to a level and decrease at the closing. It can sustain the upside move. And look at this one when it breaks out its pivot point here. What comment could you make? You don't see something different between this bar and these three bars? What could you say? It's not a, okay. Yes, they didn't leave a long tail because, yes, really good, Juan. It's in fact, what you see is that things changed. The behavior of the stock changed. Every time it tried to, yes, lots of overhead supply. Here, every time the stock tries to reach a level, there is a down pressure, a bear pressure, and the stocks close far from its highest level of the day. But this day, this special day, curiously, the day of the breakout of the pattern, the double bottom, it closed near the high of the day. It means that until at the closing bell, the bull were the winners, in fact. So you have better chance to stay on the stock or to enter the stock on this kind of bar than on this kind of bar. Sometimes there are reversals that work. Okay, but you look at statistics. You want to make all put all the odds in your favor. Okay, and here the moves. It's a four. Okay, it was I think a stocks about the numeric, or I don't know how to say it in English. The paints, blockchain paintings. Yes, also possible that on those 3 days the market conditions weren't supporting the moves. Yes, maybe. I don't know. In fact, I don't know. Yes, it's an explanation. Yes, but the markets, it's people, it's trader, it's algorithmic, it's trading computers. But in fact, who cares? The stocks couldn't support his move, whatever the reason. You understand? I don't try to look deep into the reasons why, because I think it's a big loss of time, and more than that, it can be counterproductive. But it's just my thought. But you're right; it can be whatever we think. And here you can see nothing here. It went, in fact. Yes. Well, if the market sentiment is down, negative, it can lead to lots of phase breakout. Yes, but you can be really good at timing the market, for example, or using a market sentiment. Florent, is what you told me. Use a market sentiment to have a feeling if he can buy today. No, I tried to make that, but I lost so many trades. I don't have an opinion on the market. And what is good in breakout trading when you wait to close, when the market enter into bear territory, you don't have to do nothing because there is no breakout opportunities. I followed, like the river. I don't have to do any market timing. I used to use a method, so-called method, to time the market, like distributions days that William O'Neill taught, but it didn't work well. So I don't try to guess the market. I just try to find a robust method or strategy who just adapt to the market condition. If you use breakout trading at the closing price, when the market is weak, and you don't have any breakouts. But it's how I build my system. And it went from 4 to near 20 to 2,000% move in 1, 2, 3, 4, 5, 6, 7, 8 days. Strange, eh? Florian, when you can, it's Ruan who asked, Florian, when you scan for these stocks, do you look for specific average volume and specific market cap size? No. In fact, no. I don't look. I look at price. I'm going to show you something rapidly. Okay, rapidly. I'm going to show you something. Alors, comment je fais? Ah merde, je peux pas. Comment je fais pour aller sur Internet? Oh là là. Okay. I'm going to show you. Yes, enter small caps, nano caps between 5 nano caps, about 10 million capitalization. Okay, and structurally, but I was on stocks like GME, or I was on like Sava, or stocks that can have a $1 billion capitalization. I don't care. When they have a big move, I just look at the price. But structurally, yes, I am a nano and micro caps, and I use Market Smith, which to me is the Rolls Royce if you play stocks for screening. But there are about 130 screening indicators, and again stop, and I use just one. And you want to be surprised by the. Alors, tu vois le truc qui arrive jamais. Oh yeah. Here I just have one screener, one single screener, but it's not good or bad about screener. It's just logical. I just look at the price, and I don't want to. I don't use indicators. I don't want to overfit things. Over optimization is a huge trader's killer. Overfitting, data mining, overcomplicating. Many people are the brightest mind in the world, and can't make it in the trading because they want to justify that things need to be complicated. It's wrong. Here I have just one screener. You see, I don't know if you know Market Smith. You have here many different screeners, like fundamental screen. See, it's William O'Neill. Yeah, you know William O'Neill maybe. Here you have about 10,000 stocks and ETF. Okay, it's about on the US stocks your market. I'm talking about Nasdaq only regulated the market. Nasdaq, Amex, nice. You have 7,000 stocks, 7,500 stocks. Okay, you have many indicators: sales, industry sector, shares and holdings, price and volume, and about, if you count 6, 37, etc., you're about 120. And I use one price of 20 cents. I don't like under $1. It's really hard to play the stock. Only a price change of at the closing of 50 and more, 15%. And yesterday I had only 11 stocks that fell in my screener, but I think there was about only one opportunity yesterday. The market, reached an historical high, I think, on the Nasdaq, and it's weak for me. There was no momentum, but I don't know. I don't care. And if I use a volume, yes. What is good on this platform is that you have here the price, the volume, and here this 4,000% is the increase. But I took this trade. I took this one. In fact, this is the only one I took yesterday. This one, the bar price is 90% increase in the day, and here I don't use a moving average. I only use my iPhone to place my trade and make my screener. But here it's a default settings, okay? But I don't have a moving average. And here you have the increase in the average volume. It means that this is you can see it visually. It increased by 50 50 times the average volume, considering the I think the 30 latest days. Okay, you understand? So I have questions still. Good. I like questions. Yes, percentage has many. I just look at the price. But well, yes, I like to be, logical. I got to understand things. If you look at charts which in the last classroom we watched the stocks charts back to the beginning of the 20th century. Okay, it could have been a stock here. You couldn't make the difference. You couldn't, because a stock rise, make a consolidation phase. Look at the cryptos. I don't look at cryptos because it's unregulated. There is no clearing house. Why not? On the fundamental point of view, cryptos, it's innovation. It can lead to many things, good things. I don't say it's not good, but the market is biased against the retail trader. Okay, but if you look at cryptos, you will see the same thing. Even if there is manipulation, you will see the same thing. Okay, so when I look at charts, I don't look at indicators. I look at the story. I look at human being. Okay, it's only, and I don't search for explanation. Sometimes I'm really surprised that the same patterns appear again and again. I can't explain that, but I don't care. I don't need an explanation. You see my screen? I don't know if I understand. I answered to your question. I like that, reading the emotion. Yes, you have to read the emotion, but just to have a grounding into the building of your strategy, not for the pleasure of reading the emotion. I think, you're not here to feel pleasure. I'm going to tell you something. I tweeted 2 days ago. Okay, yes, thanks. You're welcome. It's really boring what I'm doing. I really don't like. I just wait. I do many other things during the day. I work about 10 to 12 hours a day, searching, backtesting, reading. But in fact, my training is about, my routine is about now, it's really, I have 40 points of control every day, 30 points. Yeah, you saw my strategy. It's really simple. I have 30 points. I check my stop. I check my risk. I check my average position size. I check my screeners. I check, and I have to check every day. I don't miss a day, because I know if I miss a day, it's no good. Okay, but in fact, it's boring. It's really boring. I don't care. You know that you're going to lose 70% of the time, and on the long term you're going to win. And maybe I can be wiped out by the market, but like dying, crossing a street, like dying at your desk if you work, if you have a job. There is no sure things in your life, but in training, it can be a boring job like any other boring job. What is exciting is building something robust that you feel, that you trust, not money for money. Okay, so it's how I think things, but you can think things differently. Okay, so here the double bottom again. You can see. I think it's a boring, in fact, maybe a boring classroom. I saw people quitting because, in fact, you talk about always the same thing. Look at the charts I show you. I hope you will learn something, today. But learn a chart is into a whole system. A chart is nothing more than a tool. Okay, like a car. If you take a car, you get faster to point A to point B faster than if you go by foot. You understand that? But it's just a tool. I need charts, but you need to understand what it as an edge, statistical edge, etc. You can't say, oh, I know when to buy, I know when to exit. Even if you know that, it's not enough. You understand? Here again, I don't have to say much comment here. It's not a big personality, this stock, okay? It's a little boring. It breaks out with increasing volume, but it's not, I'm wondering if I took this one. I'm not sure. I think I didn't take it because I think it was too lazy. And it was about a price of 13%. But it went, so what I realized, I don't know for you, maybe you challenge what I said, like I told you, when you are when you have two consecutive gaps, you have 90% of the chance that it's the end of the move. The end of the move. The move on your time frame. I don't say that this stocks, I don't know where he is now, will not be at $100 in 1 year, but I don't care. It's not my time frame. When I say the end of the move, it's because I define what a move is for me. You know, I can't accept not to take my profit even sequentially at this level. Okay, I will exit about 80% of my position and probably 100% of my position here. Okay, not because I feel that it will not go on. I don't feel things. It's sad, but yeah, 10 years ago, I thought I have, a gift, a natural gift. Like, the Sultan of currency, he said, this guy on Forex, he was in the Jack Schwager, Bill Lipschutz, yes, Bill Lipschutz, I think, and he was the Sultan of the currencies. And he said, you have to have a gift, natural gift to succeed in trading. I really don't. I really don't agree. You don't have a natural gift for trading. You have to have a special mind. You have to be a lone wolf. You have to learn by yourself. You got to see things clear. You have to learn by failure. But you don't have natural gift for trading for me. You are not a Mozart. You're not supposed to be a Mozart or a Picasso, a Monet, or Michelangelo, etc. Yeah, it's my point of view. Okay, everything that I learn, everybody can learn it, like everybody. But it's hard. Yes, it's true. It's hard. It's harder for people like me who are really pretty slow. The only strength I had is that I didn't give up, and I was like, I'm going to like stubborn. I don't even know if it's a strength, Okay. And here again, so we're going to change after that. Double bottom, you have FSL, a good trade. But you see, like volume is secondary for me. It's good, but it remains secondary. The price does everything, and volume, it's not a lagging indicators, it's an objective indicators, but in fact, tells less to me than the price. Okay, we could talk about that, but having a beer together, but for example, a cup of tea, but in fact, sometimes you see breakout with not good bull appetite or not good momentum, and still being good trades. Okay, I am in my personality, I hate to regret, and I think it's why I was so stubborn and not giving up after 10 years of losing my money of my family, crashing my trading account 7 or 8 times, etc. But I think it's really ingrained in my brain. I hate regretting. I prefer to try something than to not to try. Okay. So when I have a doubt, I have doubt every day. Sometimes you have obvious trades, like some I showed you. But when I have the pivot point, I have the patterns. It's not perfect, but I say there is 50%, 50% it works. I will take the trade because I don't care if I lose 1%. I prefer to take. I can't be in the doubt every day, but I will say that I prefer to be in than to be out. If this is I have a little hesitation. You understand? You have to. You can say no. It has to be perfect. Okay, it's your choice. But remain the same. Okay, don't change. oh no, this time I'll take, at this time I don't take, this time, oh, I'm going to take the second bar, oh no, the volume has no importance. No, that's, you know, write things down, and you have to be accountable for everything you write. Again, I say it's not, I'm really far from being a genius, but I'm writing about 150 pages per month. And between 100 pages and 100, you know, this kind of pages. It's on my iPhone, and on the notes, you know, the notes, and I write all day. It's really hard to write everything because you're like obsessional. I didn't do that. I did that. I changed that. My position size was good, was not good. In fact, I don't talk about my winning trades. Everything that's not good, and I have to write it down because I got to assess that was not good. And tomorrow, in 1 week, 1 month, 1 year, these mistakes will have disappeared. You understand? Because you can make, somebody asked me at the last classroom, is there something impossible in trading? No. Nothing is impossible in trading. Okay. Okay. And again, you will have this because you can find 6, 7, 8, 9. 9. You can find. I will send it back to you. It's not, you know, it's not really a bestseller. Okay, it will be not sold on Amazon and be the first trading content. I don't care. But what I like is, you know, that you use that for you to say, okay, I play Forex, I play day trading, but what he said about my, you know, I kind of maybe challenge what he said. Maybe I heard that last time. Maybe he's right, or maybe he's foolish. Maybe, but maybe it will bring you something, even if you don't agree with all that, what I say. Okay, it's like you know, in French we say esprit critique. Critical spirit. No, I don't know how to say that. My English is not that good, huh? And here, yes, you enter here, $2, and it was a good trade because the back like a short squeeze, and many shots were killed here instantly because 40%, even with a 20% 20% position size, your account trade is wiped out overnight with this trade if you're short here. Okay, and I think there are many people who died that day. Look at the volume, $200 million. So I think many times I'm the counterpart of people buying back their shares, you know, when they were short. Okay, I'm going to, you know, what time is it? The flat base, we are going to, you know, pass this really fast because you will have time. I'm not sure you're going to learn many things. After that, we're going to see faulty patterns. I'm going to show you patterns that I should have taken or I shouldn't take. And to tell you, okay, it's good to see a super stock, super eagle stock, but what about when you lose, okay? And we're going to talk about that. The flat base, it's always the same. First movement, here there is no momentum. I can't enter this here. And you see there is no really huge power. It's again and again and again, you see here at the end of the move, big increase in the volume when the price decreases, and it start building a base which is a little chaotic, you know, not as harmonious I would like. And this trade is hard to take for me because it's what I said, it's hypertrophic or hypertrophied. I don't know what to say in English, but when things are really, I really work with contrast. I like, you know, talking about contrast, you know. So the pivot point is things change, you know, at the end of a move, things much change. The behavior of the market change. I'm always entering a trade with when, you know, inflection points, when things are differently, like night and day, like, you know, I used to talk, I talk about, you know, you hear a big Aston Martin with a big motor, and you watch this big car, a Ferrari. I don't care, and I don't know, and who happens to come really fast, and it stops, and you watch the even if you don't like cars, like I do, I don't really like cars, especially. I like to hear this motor, like a big cat, and you see the car, and unconsciously you're going to expect the car resuming his move with the same powerness, with the same speed. If this car happens to come really fast, stop, it will probably go fast when he will resume his journey. I don't know how to say it, because there is the car, but there is the pilot in it. Okay, and I like to see things change, but I like to see what kind of cars I'm supposed to get into. For example, if you like to go fast, you choose a power. How do you say? A big car, like an Aston Martin or Ferrari. Okay, and I like to be in the strongest stocks, even if this Ferrari just take me just for 100 meters. You understand? Because I won't stay that much. If I stay too long, I will be dead, because I am on stocks who are, who have poor or loosey or faulty fundamentals. So this strategy, and you're going to see, it's not normal, but I like contrast, but there is too much to move here. The pivot point you are here, pivot point, maybe this here pivot point, the highest of the base, but look at the stocks here. It went down to 0.7, here 0.5, 0.7 divided by 0.2. Yes, it fell by 40%. Okay, so I don't know if I took this. I don't like to regret. So probably if this was the stock yesterday, I would have taken it, okay? But I would have put only 5% of my capital. And I would have put 20% stop. And you will say, 20% stop? But what about your risk reward? If you put a 20% stop, you're going to have a lose risk reward. I don't like to have a risk reward less than 5. So I would tell you, I suppose this stock, considering my back testing, my experience, are a high probability, if he don't stop me out, to reach about 3. Okay, so 200%. With even with a stop of 20, I have a risk reward of 10. Okay, so it's logical that I take this trade. You understand? It's not. I take 200%. We don't care about that. Be logical. I assess my risk reward before entering the trade. Okay. So, and here I would have been stopped out, because 40%. I never put a stop of 40%. It will be a strong mistake for the same reasons that I told you 5 seconds ago. So, but I will have taken this trade again. Okay. It's only 3 bars. I don't like below 5 bars. Yes, true, but it's just that it consolidated on his pivot point. Okay, so it was really healthy. I would have taken, maybe, I don't remember if maybe I would have taken retaken this stock here at the closing price, and you see. You have a gap here, but a gap just after the beginning of the move. So I would have exited the trade here, because it wouldn't be logical considering my back test and etc. Okay, here 1, 2, 3, 4, 5, 6, 7, 8, and in this area I am the red zone. Here there is a gap after a 5-7 move. To answer to the question asked to me earlier, if I exit when about when my holding period is 11 days, for example. No, but here I see a gap, and I see the biggest volume here after the move, and we have at the 7th or 8th day, and I have about reached my I don't have target price. I don't have, but I can. People say without target price you're dead. I'm sorry, I don't have target price. I'm not dead yet. Okay. Everybody says according to his conviction. I say indicators. I don't believe in them, but I suppose there are people who make money with indicators. You know, we can't be too affirmative. You gotta have a philosophy, but respect others. One also. So, but I will get out here because it's a good trade because it's 200%, and it's my average winner when I'm winning. Okay, so it's just logical, etc., etc. So there are the you're going to watch the because it's been about 2 hours almost, and I want to give some insight to you about the faulty the cup without handle. You have many examples here. Okay. Here's a recent trade I took in October. Here, look at you have the closing price. You have a reversal, but the reversal is in the upside. The body. You are in the how to say the upper part. The upper part. Okay. So look at the 3 preceding bars. They are really tight. It's beautiful here. It's really. I really look always at the 4, 5 letters bars. At the closing, yes, at the closing. It's not a look bias, a look back bias. I just have the closing price here, like we were at the closing bell here, and I look and say, oh, look, 3 tight bars just before the breakout, and there is no. I didn't put the mood. In fact, it opened at 8. The day after, so it was a 44% move. Okay, 400% move. Okay, so many yes, here faulty patterns. Okay, I put just few example. We could talk about that for during hours or days or weeks. Or I could myself. What amount of people we got deep into the details, and we have time to explain every many things so that people get the right habits, even if you don't have the same strategy like I have. Look at this pattern. It's a faulty one. Okay, here you have the big bar price. You have a spike here, but look. You can name it. In fact, you can't name it. Here, you have only 2 days. You have like a flat base. Yes, you have tight areas, but it's chaotic. It's anarchic. It's there is no consolidation phase. The weekends had no time to be stopped out. There is no. I don't know how to explain it. In fact, okay, it's not. You could say otherwise. It's not cup with handle. It's not a double bottom. It's not a cup without handle. It's not descending wedge, etc. Yes, it's true. But in fact, you see with your eye. I don't know what you think about this pattern. Yes, I'm going to because I had a difficulty to explain why it's not harmonious. But what do you think about this pattern compared with the others? What could you say? Because I'm talking a lot, and maybe I don't let you talk enough. So look at those patterns. They are, I will say, harmonious here. Look at this one. Look at this one. Look at this falling wedge. Look at this falling wedge. Look at this flat base with a volatility compression pattern. Even here, and look at this one again. Sorry. There's things we can't explain. In fact, I couldn't take this one. Yeah, it said nothing. It's you know, it's chaotic, and it spikes, and without having formed a healthy consolidation base. And maybe it's because we have not this famous minimum five bar consolidation base. You know, like you go up to the at the top of the Everest. There are bases. I don't know if you climbed up to the Everest, but there are, we call them bases. You know, a base camp. Okay, people don't go from 2,000 feet high to I don't know. I use meters. You use another metrics, but you have to rest. You have to retake your strength. You lack air. You have it's the same with stocks. You have to go step by step, like in your trading journey. If you make a killing with just a trading account of $5,000 overnight, you will kill yourself, because you will not take all the incremental steps that are needed. Like if you go deep into the ocean, if you go up too fast, you will have a you will die probably, you know, because the body can't bear the pressure, and you have you know to take things step by step. Okay, and a stock, if you want to take a big move or to have a reasonable movement, you have to respect some rules, and the stock have to reach a level where the hesitation gets into or turn into a real conviction, and you need time. And here there is no time. It's erratic. There is confusion. People have not enough time to rest, etc. I don't know how to explain it, but I see that it's a faulty pattern. Maybe I gave you some clues, but you could make a better summary than I. Here again, there is no foundation. Boom. There is. It's like an explosion. There is no premises. You know. Sometimes when there is a danger, we can anticipate things because we smell a odor of gas, okay, before the explosion. Here we don't have time to see or to smell something wrong. Boom, and with a strong reversal, and at the middle, and the closing price is at the middle of the whole candle. You understand? And boom, it falls down like a stone. Here again, it's yesterday, I think. Yes, so it was just yesterday. Look, it's a faulty pattern, like maybe a cup without handle or a flat base. Yes, but look at the reversal, and after that, there is no tight consolidation. There is confusion. There is hesitation. The bar price, the red candle, and the green, the red and the white candle have the same, move. Okay. And there is no tight areas. I didn't take that, but and look at the volume. It decreases, but not that much. Here, the volume, the red candle is accompanied with a big increase in volume. So it's dangerous. I don't know what it's going to do on Monday or Tuesday, but I can't take that. It's a faulty pattern. Yes, other example of bottom fishing. I put many trades I took. Here, it's a beautiful trade, like a bear trap. Bear traps, like it reached a lowest low, and suddenly, boom. And here there is there are many people who are trapped. It's like a short squeeze, and you see that the bar price with a strong volume is reach a level where there are many short sellers who are dead at the end of the day. Okay, so remember that when you short a stock, you borrow the stock, you sell the stock, but you have to buy back the stock. People say that the crack the short seller are the reason of the crack. No, there are about 5% of the traders who are short, and they have to buy back. They have to buy back the stocks. So they contribute to slow down the pace of the decrease in the move. Okay, or the falling move. Okay, and there are other, I don't know, maybe it's not original, but many things I like, bottom fishing, like the best, the explosive opening gaps are interesting because often you have a real, at the sense, here you have a resistance here at about 0.4, and here 1, 2, 3, 4, 1, 2, 3, 4 attempts, and here it breaks out many gaps at the opening are faulty or fail, but sometimes it's worth trying, and you see that really it takes off from the level of 0.4, and after that it reaches a good level. Okay, so it's hard to in 2 hours to tell everything about stock charts. There are many other patterns, but I think you get to stick at 2 or 3 or 4 of them, and to be an expert of them in them. So you can exit into strengths which limit your drawdown. It's good to, and it's you work on your humility, because but if you always exit your whole position in strengths, it's not good for your mindset, because it implies that you know something. You don't know the end of the move. You can have a feeling for what will happen, but you will never know. So if you set into strengths just to limit your drawdowns or to lock your gains, you should at least exit a portion of your position, like 30% or 50%. It's good, because after that you feel confidence, and you can manage the other 50% free of mind. So exhaustion gap. So yeah, there was a good chance that it could fall after that, and you could have locked about 50% of your position exit here, and wait what happens next. I don't remember what happened next. Okay, and here, for example, it was a trade I made in November, early November, at 2, at 2, and here you don't know what will happen, but when you have a gap of about 200% at the opening, you'd better sell part of it. What I did, but I didn't sell everything, so I sold at the opening, so which was the ISI, but I don't remember exactly, but I think I sold the remaining part at that level. Okay, with like a trading stop. Here you saw a part of the price bar at the end of the move. It was AMC. I don't know if you heard about that. If you play stock, it was a big, huge move. Like it starts from 15 and it reached about 17, 500% move in 7 days. Again, 1, 2, 3, 4, 5, 6. And you see at the end of the move, so relatively speaking, you have a bar, a big, huge bar. Yes, it closed at the high, at the highest high, but beware, this is the end of the move, not the beginning, because there was it didn't this bar price doesn't appear from a consolidation base. You understand? You have many people who make a lot of money and would bought at the beginning of the move, so you'd better exit at least 50% of your position. That's what I did, I think. And after that, even if you sell here, you have locked a good move, and you have a big risk-reward ratio. with remember that a trade like this, you can lose if you took always those kind of trades, which is not the reality, but it's about you can lose 98% of the time, because you have a risk reward of about 600% with a stop at 10. You can lose 1 divided by 61. When you have a risk reward of 3, you have a risk ratio of 25. When you a risk reward of 10, you have a hit ratio, break-even hit ratio of 1 divided by 10 plus 1. Okay, so it's interesting. And here, the elevator rule, I'll talk. I just it's my imagination, but I like to adjust to adapt to the specific behavior of a stock. Here, you see. I don't know if I can. Yes, here you see. Here, you wait. There is nothing special to do on that trade. You have to wait. If nothing special, it's if you use moving average. If you have quantitative way of exiting a trade, just go on. If you have an edge, just go on. I just share my insight about that. That you can adapt to. There are not as many configuration. There is not so many configuration to assess. But look at this trade. Here, he has a specific way. Like I said, the elevator rule. He obey to this rule. The low of the day is always higher than the low of the preceding day. And he does every day the same thing. So if he doesn't obey anymore to this rule, you have to get out. This is a contrast game trading. When things change pace, change behavior, just think twice. Like people who change color, I don't know, who change behavior, was strange. All human, we are spaces like animal spaces, and we want to optimize our expectant living expectancy, life expectancy. Okay, and we look at everything that's strange around us. A stocks, it's the same. If a stocks have a low higher than the preceding low, always the same, okay? If it doesn't obey anymore to this rule, it's what I do on this kind of stocks. I put my stop beyond this bar, but not for every stop. Like you saw, you can. It's a big rocket stock. You get to if there is a big gap, a big bar price, hypertrophic bar, you have to adjust to the stocks. And it's magic, because there are about 6 typical patterns of a stock. You understand? Even if you take a slower stock, look at Amazon, Apple, etc. You understand? So what I say is that you can have a quantitative approach, really a quantitative approach, but you can also adapt to specific behavior which obey to specific pattern and recurring patterns. It's not because this is different every time that it doesn't belong to categories. Like if you study behavioral finance, you will know that there is specific kind of people, like the guardian. You have the active accumulator, the passive preserver, and how your bank put you in categories when you want to they want to assess your performance objective in your asset allocation and your risk tolerance. A stock is like a human. It's a sum of human. So it's how I consider things. But I think I consider reality, and it's reality because it's math psychology. Using indicators, it's good, it's math, but for me, there is less reasoning, less grounding, less. Like I say, my daughter understand what I do, because they see bars and say, oh, it changed here. Yes, it changed here. So if your And if you or your daughters, your son understand what you do, I say your 10 or 11 year son or daughter understand what you do, you maybe you have an edge. Okay. So I didn't want this classroom to be too academic. What I said to you that you can have many different systems, but charts are just a tool that must be embedded in a world trading system. I used to talk 2 weeks, 3 weeks ago, and I think it's more interesting to talk about a world trading system that just are looking at charts. You need to look at charts if you are a price-action trader, but you got to search for simplicity, and you got to put at bay your emotional bias, because you know them and you know that it will kill you. You don't try to have pleasure. You try to make money. It's not. You can I love trading for the challenge behind trading. I don't love trading for the feelings, because when there are feelings in trading, they are often bad and can kill you really fast. But I love trading like building or set up a company, you know, like making a business, growing a business. I just have exactly the same reasoning. So I hope that you like this this classroom. I will send you the content, like you can watch. Maybe you will put it in your trash box. I don't know, but what I will be really glad is to answer to a question you could ask on Twitter, or if you want to send me messages on other topic you want me to talk about. The next session will be about psychology, only psychology and psychological bias with many examples. This is scientific bias. Okay. Thank you, Nakosana. Sorry, I don't know your name, but for your emoticon. Yes, you mock me. No, how do you say? Yes, only psychological bias will real example, and there is, it's scientific grounded, you know, about psychological bias. It's just an invention. So we are going to talk about the main bias detrimental to your trading success, and how you can assess them, recognize them, and how can you adapt them and correct them. Okay. So I will give you some solution and exercises that you can make. The classroom will be probably in 2 weeks. Okay. And in January, I will organize a classroom with TradeWiz, which have a tool to measure automatically. You download all your trades, and it gives you all the ratio you need to assess if you have an edge, and to focus on what you have to focus, like your hit ratio, your position size, your average holding period, etc., your risk reward. And I will make the classroom, and you will show some feature of his product, which is a good product. And I don't make money on that. It's just to explain to you, and maybe use this product. He will show you and explain the importance of measuring things. And after that, the next classroom will be on how to backtest your trading system. There are many topics to talk about, and if you have many ideas, I will take them. No, I don't backtest market miss. I just backtest manually. Everything that I do, I'll do it by myself. There are many tools, like I heard about Trading View or Approval Time, but it's you know, generic backtesting. You have to build by yourself your. Even if you have a quantitative approach, you have to build your backtest by yourself. I think this is the best way. You can assess your ratios with like a TradeWiz or automatic, you know, like software. But I think the best backtest is the backtest you have to make, because the backtest is like checking your security belt. You have to check by yourself, because you won't trust your edge when you know the market, make an high and a high and a high, the crypto rise skyrocket, but everything has an end. So the best traders are those that keep the money they made during the preceding bull market. Free money or free lunch doesn't exist. So I think you have to trust and have a strong confidence in your edge, and for that you have to make the work by yourself. So what I suggest to you about, so we keep in touch. You're welcome. If you have questions, if I can answer to your questions, I will. And if you have ideas of classroom I can host, it's in interaction that we'll learn the best. And I can learn as much as you, I hope, as you can learn from me. Nico, Sana, Ariel, Juan, thanks to every attendant. I will send to you, in fact, I don't have your, I have your email, but I didn't write down your name, but I will send to all who registered for the classroom the PDF, okay?
Thank you, Florian.
You're welcome. You're welcome. It was a pleasure. Always.
Okay. Thank you, Florian. Thank you.
Au revoir, Florent. Bon week-end.
Merci, toi aussi. Merci encore.
Bye, Ariel. Nico Sana, sorry. Unkeep and to the others, but who left?
Sure.
Bye.
Gracias.
You're welcome.